mood in the markets is shifting. That's according to our next guest. Among the catalysts for this year, a potential wave of mergers and acquisitions under the incoming Trump administration. Let's bring in Jeff Weniger, head of equity strategy at Wisdomtree Asset Management. Hi, Jeff. Thanks for being with us.
Hey, Mark. Thanks. I appreciate it.
All right. So you say the mood is shifting. How so?
Well, I think that the concept whereby we get an M&A revival is very, very real. There would be very little reason for me to believe otherwise. I think especially in the banking sector, there's 4,000 banks in the United States just waiting to be gobbled up. I think that the Trump administration is going to be very friendly to that. I think you got a bull case in concepts like mid-cap value and small-cap value because of the presence of regional banks in those groups. I also think you got a little bit of a call option over there at the FTC in that Lena Khan is going to be unemployed soon.
All right, let's keep going with your initial comments there. You're overweight equities, and the two main catalysts you believe could be tax cuts coming from the Trump administration and then deregulation, essentially, and so potentially more mergers and acquisitions, especially in financials. Can you flesh that out for us?
Sure, and on the matter of the tax cuts, I mean, the concern, of course, is, okay, you're going to cut taxes for a corporate tax rate from 21% down to 15%. Who doesn't already know that? The risk is that it doesn't end up going that far, or that you have to come up with some compromise and the cut is only to something like 18%. I think that's the primary risk on that front. But yeah, I mean, look, the stock market is looking at a 2025 where I think there is a street consensus that sentiment is extremely ebullient, and I'm not so sure that that's necessarily true, Mark. Reason being because though you have things like B of A fund manager survey showing basically nobody has any cash, and that's disconcerting to say the least, and certainly you also have the conference board question of the general public, whether or not they think stocks are going to go up in the next year, and it's in a record high, and I'm worried about those things. But you also have things like the AAII survey, which I have in something like the 37th percentile historically, where they ask, the survey question asks whether or not you're bullish or bearish stocks. Investors Intelligence, that survey is in an 84th percentile. I've been running these percentiles for years since I was over at BMO, and we used to historically find that unless you're in the bottom 5 percentiles or the top 5 percentiles, most of these sentiment gauges are pretty useless as a contrary indicator. So there's a lot of, believe it or not, a lot of middling views. In fact, on the AAI side, there's almost as many bears as there are bulls.
Now, in terms of that unprecedented public optimism, according to the conference board, does that at least give you pause? Are you concerned at all?
Oh, yeah. I mean, definitely. I mean, I'm sitting there tweeting about that throughout December. I mean, it is literally several percentage points on a net question of, do you think the market will go up or will it go down? Several percentage points higher than the previous record, which was in January of 18. And the viewer may remember that 2018 was a pretty sideways, choppy, quasi-nasty type market for stocks. So yes, it certainly gives me pause. I think if you're one of these guys kind of like me, where you're saying, look, I don't really know what the next year holds for the market. There are certainly indicators like that where there is a speculative fervor in certain pockets of it. Then the risks are going to be in things like the NASDAQ 100, NASDAQ Composite, and those types of mandates. So what we've been telling a lot of our investors is, look, if you have a NASDAQ type allocation, make sure that whatever that may be, that it's screening highly for quality so that you could have some decent downside capture. And then on the other side of it, for perhaps the other half of your large cap allocation, really be thinking about companies that are buying back stock, because I think that this administration will be more favorable towards that, and try to get your valuations on net lower than the 23 times forward earnings that we're looking for the S&P 500.
And further to that point, Jeff, you're looking at the correlation between large cap and small cap, and you've identified what could be the early days of a multi-year run for small cap. Well, what is that correlation?
Sure. Well, it's when the correlation snaps. When you go back through history, usually at any given time, you run a 10-week or a 20-week or a 30-week correlation between something like a large cap Russell 1 and a small cap Russell 2, or you could use the S&P 500 indices. And those correlations are oftentimes 90 or 95, as they just bop up and down together. But twice in 2024, that correlation broke down to negative territory, almost unprecedented. The only other times you see those types of big market fractures would be the GFC and the dot-com era. So if this market wants to fracture, if it wants to start taking out potential trouble zones, I would hypothesize that it would be those types of areas in the market that have been the most powerful and the strongest on the upside. And that's been the Mag 7. I think that's where some of the vulnerability lies. There's some castles to the sky in those groups. That would be the avoid. And you could have a situation where if there's a bear market, that's anyone's guess, it could be a situation where on the downside, small caps are not your pain point. I think that would roll a lot of eyes. I think a lot of people would be surprised to see it, but it's a distinct possibility.
You may have touched on this, but do you believe that with some deregulation in the United States and the potential for more M&A, as we've been discussing, that could favor small caps? A lot of small companies would be very attractive.
Yeah, think about it. When you're doing the acquiring, it's the big player buying the small player, and it's the small company whose stock pops, and oftentimes the large company's stock sells off upon that announcement because they think it's not accretive to shareholder value creation. And so, yeah, absolutely. Like I noted, I think the regional banks, there's going to be some targets. I think there's going to be some notable household names that are going to be taken out very, very soon. In the regionals, there's a ton of them. They already kind of got hit back in 23 when SVB and Signature went under. And now not only do you have the possibility of the regionals being taken out, but up there in large cap and mega cap on the banking side, who's doing the underwriting? Who's doing the investment banking work? And it's the big city banks. So they could have a bull trend as well relative to the broad market.
Thanks for your time and perspective today, Jeff.
Have a great weekend.
All right, you as well.